Naked Forex Trader. I wrote the book Naked Forex, and I'm going to share with you a really simple way to grow your account faster. In fact, this is going to be one of the guiding features that we're sort of guiding principles that we're using in the Small Account Big Profits course. And I want to share with you exactly how you can do this for yourself. So let me jump into this for you. So what I have here is a spreadsheet. And all this really does is allows you to take a system and plug in the numbers and see, you know, what may happen. This is only one sequence of trades. You got to do this hundreds of times to get kind of an idea of what may happen. But let me just share with you what this looks like, okay? Let's say that I want to risk I have a $1,000 account and I want to risk 2.5%. My average winner is $220 or $22, whatever it is, 2.2 times my average loss. So if I'm losing $10 and I'm making 22, or if I'm losing 100 and I'm making 220, you get the idea, right? I have a 41% win rate, and which of course is interesting because it's less than 50%, but that's fine. And what I'm going to do is I'm actually going to add my winning result to the next trade. So let me show you how this works. I'm just going to put another number in here because this will recalculate. Every time I change something, the spreadsheet will actually magically recalculate. So let me give you an example of what this looks like here. So I'm going to go to the first trade right here. And you can see the first trade was a loss of $25, which of course is 2.5%. The second trade was a win, so $153.63. Now this is what's interesting. On the next trade, I risked the normal 2.5%, which is just under 25 bucks, right? Or just over 25 bucks, I should say. And I risked my winnings from the previous trade. So that's what this is doing right here when I set this number. I'm just risking. And so because I actually lost not only my winnings on the previous trade, but I lost the 25 or 26 bucks that I risked on the trade, because I risk 2.5% on every trade. And I don't have to do that. I can just say no. And then you can see here what would have happened is I just have the exact same amount that I won is risk. So I lose just the winnings on the previous trade. So I could do that as well. But I actually prefer, when I do my trading, I prefer to risk the winnings plus an additional 2.5%. So what this does here is this shows you what happens. And you'll see it's pretty obvious. What happens is when you get a couple of wins in a row, so here's a loss of $112. The account's up to $1,400. You can see here after trade 23 or whatever it is. You lose 112 bucks here. Then you win $73.95. And then because I've added the $73.95 to my 2.5%, I'm now risking $109.41. And because I won that, I get a payout of $240. So my account jumps from $1,418 to $1,659 in two trades. And then of course I had another winner here, and that jumped it up again. But then because I risked those winnings, that $91 on the next trade, it's lost and it drops back down to $1,615. So this is how it works. You can see here when you look at this, it's a wild ride. Okay, nobody's claiming that it's anything but a wild ride. But here's the thing: if you're able to ride this out for a long time, it will pay off. You can see here it may take a long time before it pays off, but it does eventually pay off. In this case, it looks like we get up to, let's say the goal is 100,000. We get to 100,000 around trade 407 is what this is. So after 407 trades, because I've been using this compounding at the trade level system, I'm able to increase an $1,000 account up to 107,000. It's as simple as that. So that's basically how this works. It's not very complex. It's not reverse martingale. A lot of traders talk about how this is reverse martingale. Reverse martingale, of course, is a losing strategy. Reverse martingale, so martingale strategy, as you probably know, and you can find these martingale systems, a lot of those signal sites where you can sign up for the signals and attach your account to theirs, they run martingale. And so what will happen is the account will go up, up, up like a perfect 45-degree angle, and then the chart will just go like that. And it'll either wipe out the account or nearly wipe out the account almost every time. Those are martingale. So and the reason why it's martingale, of course, is uses the gambler's fallacy. After you win, you go back down to the normal risk amount. After you lose, you take the money that you lost in the previous trade and you add it to another amount that you want to risk. And then what you try and do is make back the last winnings, the last loss on your next winnings. So you could have 8, 9, 10 trades, and you might be risking $2,000 to make $50, for example. That's martingale. Reverse martingale is the opposite. So every time you win, you add more, and you keep adding more after every win instead of every loss. Now with reverse martingale, the same thing can happen. The only way that reverse martingale works is if you have dependency in your system, that your winners are more likely to follow winners. And that's not always the case. It could be the case, but it's not always the case. So dependency is the key there. Now, what this does, this method that we're going to use in the small account big profits course, you can click the link below or above this video to get information about it. We'll use Profit Bricks among our tools. And what Profit Bricks enables you to do is simply compound at the trade level when you have 2 winning trades in a row. That's it. If you have anything other than that, it's not so good. If you have a win and a loss, not so good. If you have a loss and a loss, it's the same as normal trading. If you have a loss and a win, same as normal trading. The only time it differs is when you have a win. And then what follows that is critical. With Profit Bricks, when you follow that up with a win, boom, you get this massive increase. In fact, if you look at the spreadsheet here, here's what happens. So instead of making 2.2 on that winning trade, so if I'm risking $100, I make $220. Instead of doing that, I actually make much more than that. If you think about it, on trade 1, let's say I'm risking $100, okay? So on trade 1, so I'm risking $100. On trade 1, I make $220. So now on trade 2, I'm going to risk $320, right? I'm going to risk my original $100 that I risk on every trade plus the $220 I made. So now I'm risking $320 on trade 2, and if I win, I get 2.2 times 320. So that's actually equal to that times that. Okay, so my total winnings is $704 plus, and this is important, plus it's the 220 that I started with. So I made $924, if that makes any sense. So that's really critical. I'll show you on the chart here so you guys can see. Here. It's right here, guys. I want to make sure you see this. So I have $100 right here that I'm risking on a trade 1, and I make 220 because it's a winner, okay? Then I take 320 because I have the winnings from my first trade plus $100 that I'm going to risk on any trade anyway, and I get a payoff of 704. So what that means is my total winnings is now trade 2, 704, plus trade 1, 220. So that equals $924. That's where Profit Bricks comes into its own. That's where it really works. And that's why this can build an account quickly. If you'd like to join us, you can click the link below. I wish you very happy trading. Do you use artificial intelligence? No. I have automated systems. I used neural networks back in 2006, but it's not very useful. Simple trading works better for me. So how much do you put in a small account, big profits? $1,000. I hope you're having a great, hey, Bahan girl, great to see you here. Great content as always. Glad you like it. PDL US 1310. Hey, buddy. If you have time in another video, can you talk about your structure on backtesting new ideas? For example, minimum sample size. Yeah, sure. Yep. We'll do a backtesting video. No doubt. Yeah. All right. Thanks for your time, guys. We'll see you in another video. See you tomorrow. See ya. Bye.